So, after the discussion on the equity valuation using the discount flow models, which includes the dividend discount flow, the operating cash flow and as well as the free cash flow to equity, we have another approach we use for the valuation of the stocks, that is called the relative valuation techniques. In the relative valuation techniques, we are using the different ratios for the valuation of the stocks, and there is a relationship between the discount flow models and the relative valuation techniques also. So, which are those major ratios we use for the relative valuation? For the relative valuation, we use the earnings multiplier, which is nothing but the price to earning ratio. We can use the price to book ratio or market to book ratio, either of these names can be used for this. Then also you can use the price to sales ratio. These are the major ratios which are used for the valuation of the equity in the relative valuation sense. So, whenever you talk about this, you will find that this will give you idea how it is different from the dividend discount flow models. In the dividend discount flow models, what basically we are trying to do, we were trying to basically find out the intrinsic value of the asset. But whenever we are going for the relative valuation techniques, in the relative valuation techniques, the values can be determined by comparing the similar stocks based on the relative ratio. Mostly this technique is used to understand how the stock is going to perform in the market. Let us give one example. For example, let somebody wanted to buy a house. If somebody wanted to buy a house in Mumbai and another person who stays in a relatively smaller town, and the price of that particular asset or the house in the smaller town cannot be compared with the price of this particular house in Mumbai. What is the reason? There are many other factors which are also affecting the price of this particular house. So, whenever we are comparing, the comparable entities should be also similar or they should be comparable in nature. So, in this case, in the relative valuation part, what exactly we are trying to do? We are trying to compare the different ratios to decide that whether we are going to invest in that particular stock or not, or how the value of the stock is going to perform in the market in a particular period of time. So, therefore, the similar stocks has to be chosen. If it is a bank stock, then you can choose the different banks for the comparison. The bank stocks ratios cannot be, or the companies which are basically producing the other tangible products in the market, that comparison is not possible. If somebody interested to invest in the bank stock, they have to compare between bank X and bank Y. Instead of comparing bank X and bank Y, if they are comparing with bank X with some other companies X, then that is not going to help them to decide that whether really they are going to get the benefit from the market using this particular ratios, or how the value is going to be changed, that judgment will not be possible in that sense. So, therefore, the comparable to similar stocks in the sense that they may belong to same industry, they may belong to same size, they may belong to same type of products, whatever kind of ways you want to define it, you have to define a similar stock, and that particular stock can be used for the comparable purpose. What are those variables generally we use? Already I told you, we use price to earning ratio. Also we can use this cash flow or the book value of the asset, the sales. These are the different variables what we take up from the balance sheet of the particular bank, and try to analyze that relatively. There are different ratios we measure using these particular variables, and using those ratios we are trying to compare that whether really this particular stock is able to perform or beat the market in comparison to the other stocks which are traded in the market or not. So, that is why the comparability is very important, and choosing a comparable entity is very important whenever you are using the relative valuation techniques for the pricing. So, if you are not finding a particular company which is really comparable, then it will mislead your results, and finally, this whatever conclusion you will draw, that conclusion may not be beneficial for you. So, that is basically the another caution we have to take whenever we are going for the application of the relative valuation techniques for anything. Apart from all those variables what we are going to use for the valuation of the security using the relative valuations, the most popular approach is or popular variable is the price to earnings ratio. The P ratio, which is popularly known as the price to earning ratio, is mostly used by the investors whenever they are going to use the relative valuation technique or they are going to adopt the relative valuation technique for the investments in the market. So, here we see that what exactly the price earning ratio is. So, here the basic principle is the values the stock based is on the expected annual earnings or the price earning ratio. So, that is popularly known as the earnings multiplier. So, what do you mean by this earnings multiplier? It is measured as the current market price upon the earnings per share. What it implies? For example, somebody's any bank's price earning ratio is 5 and somebody's another bank's price earning ratio is 7. So, how you are going to interpret this 5 and 7? The interpretation will be done in this way, that to get 1 unit of the return, whether the $1 or 1 rupee, to get 1 unit of return, you have to invest the $5 for this bank and you have to invest $7 for this bank. If you are investing $5, you are able to generate $1 return in this particular bank's case, and you have to invest $7 to get 1 unit of the $1 in the B2 case. So, obviously, what you can conclude, lower the price earning ratio, it is better for the investor for investment to generate the future return. The expected return will be better whenever the price earning ratio will be lower. So, here we are really investing 5 rupees to get 1 rupee and there we are investing 7 rupees to get 1 rupee. So, in that sense it is obviously more valuable than this. So, this is the way the price earning ratio helps us, and already we know that if the market price, for example, market price is 45, earnings per share is 3 and it is a price earning ratio of 15 times. What does it mean? If you invest 15 rupees, you get 1 rupees return. But there is a comparable entity where we are investing 10 rupees, we are getting 1 rupees return. Obviously, we choose that one instead of choosing this one, where we have to invest 15 rupees to get that amount of return from the market. So, that is the way the price earning ratio is interpreted in the system. So, if you have want to have a relationship with the dividend discount model and the price earning ratio, here if you see that what is already we know that P is equal to, already we know that your P is equal to what CF 1, P 0 is equal to CF 1 divided by R minus G or K minus G. K is equal to your cost of equity or the required rate of return, G is equal to the growth rate of the cash flow. So, there if you see that if you divide your E in both the sides, then it will be P 0 divided by E 1, then it will be your CF 1 divided by E 1 divided by K minus G. Then here what is happening? You will find that your price to earning ratio, depends upon the expected dividend, which is CF 1, your required rate of return K, and as well as the growth rate of the dividend or the cash flow, that is G. So, the price earning ratio is not independent of the cash flow. So, if the cash flow and the required rate of return and the G's are changing, then obviously your price earning ratio is also changing. Further, we will see that how the change in a particular variable is really changing this particular price earning ratio of the particular bank, that we will see. But these are the different factors or different kind of inputs which are really affecting the price earning ratio of the banks stocks. So, here if you see how this price earning ratio is basically used. The P ratio basically summarizes the outlook of the future of the bank, the amount of its earnings and dividends, the timing of earnings and dividends and risk of these earnings and dividends. So, these kind of judgment you can get from the price earning ratio. How? If a bank is expected to grow or basically expected to show a rapid growth in earnings, then earnings will have a higher price earning ratio. If a bank that is expected to show rapid growth in earnings will have a higher price earning ratio. A bank in which earnings are highly variable and unpredictable, it will tend to have a low price earning ratio, which is not correct always, but this can be used as kind of benchmarks, because the people will consider the low price earning ratio companies have the better potential in the market in the future, because still the market price is not yet realized, still there is scope to generate extra revenue from this. So, even if the two banks have the same current earnings, their market prices can differ, everything is same, but the market price is differed because the market price is influenced by many factors which are not reflected through the intrinsic value of the stocks. The market price can be determined by the external exogenous factors like business cycle. It can also be affected by the different kind of unsystematic risk of the commercial banks. It can also be affected by there are some kind of other international factors. So, all those factors is not incorporated in the intrinsic value of this particular bank stock. But whenever you talk about the price earning ratio, it is a market related measure which try to capture the impact of other exogenous factor for calculation of that particular price, and that price is reflected for calculation of the price to earning ratio. So, even if earnings same, the price will differ. For the same type of company, for same size of the company, you will observe that earnings may be similar, but the market price of the stock will differ because of some additional exogenous external factors which can drive the prices or in a different way for the two different companies. The degree of impact may be different. The unsystematic risk which is specific to the organization may vary from one company to another company. Because of that, the market, and another most important thing, market price also is driven by certain unsystematic factors. And the unsystematic factors includes some tangible factors, some intangible factors. Intangible factors means managerial liability. Is there any kind of natural calamities, or maybe there are something which have happened to that particular company, but for other company or other bank that thing have not yet happening, is not yet happening, or it has not yet happened to that particular company. So, if it has happened, then one bank is getting affected, another bank is not getting affected. So, in that particular point of time, you will find that for the same type of banks, everything remains same, but the price fluctuations are different. And another one is investors' perception about that bank. Even if there is a rumor, the sentiment of the investor also changes. If the sentiment of the investor change, they may not choose that bank, they may choose another bank where they feel that the bank is a good bank. So, if the more number of investors will be inclined to buy the shares of that bank because of their perception about the bank is good, then the price of the stock also increases for that bank, then obviously the price earning ratio gets changed. So, this is what that is why there is a difference between the market value and the book value, because the earnings are basically based upon the book values. But whenever we talk about the market value is basically driven by many other factors which is not reflected in the book value measures. So, that is why the price earning ratio is a better reflection about the performance of the value of the stock in comparison to the other book value measures what we use, or the accounting measures what we use. Another use of the price earning ratio is firms with low P ratio are often referred to as the value stocks. Why we call it the value stocks? Already we have seen that if you are spending less or you are investing less to get 1 unit of the return if your price earning ratio is low. And why the price? Because already said that the P is the market price and earnings is the book value. That means, if it is low, that means the earnings is higher, but the market value is lower. That means, still there is potential in the market to grow. In the long run, maybe the particular company or particular bank can generate certain kind of extra returns. It may be volatile because there are other additional factors, but from a common investor's point of view, if you look at, then it can give a better idea that this particular company's potential is better in the future. That is why value investment will be there if the price, we can define that particular bank stock is a value stock if the price earning ratio is relatively low. And the firms with high price earning ratio are referred to as the growth stocks, because growth is already taking place or already has taken place. Still there is a chance it may grow, but for that other analysis has to be carried out. Blindly or by looking at this price earning ratio, we cannot say that further the growth will not take place, that is not possible. But if you compare it with other companies or other banks price earning ratio, you can give a comment or you can make a comment that this company is already grown, and that is why, or this stock is already grown in the market, market has perceived that particular stock positively. Further the same momentum can grow, the same momentum can go on also, but the question here is that it may go, it may not go. But whenever there is a value stocks, there is a probability of growth is relatively better, or probability of getting a return is better whenever we are saying that the market value is already lower in comparison to the earnings what the particular stock is getting. So, because of that the price earning ratio is low. So, the growth is already realized, return potential is relatively less for the growth stocks in comparison to the value stocks. So, because of that the price earning ratio is used as one of the indicators in the portfolio management process to define that what is a value stocks and what is a growth stocks. So, in that sense, what basically here we are trying to do, if you can really categorize that which is the value stocks, which is the growth stocks, then it is easy for us to invest in that particular stock in the market. So, how we can generally, the easiest way to say that which is the lower, which is higher. If you talk about the companies and take this making a portfolio, then you take a different companies and find out the mean or median of this price earning ratio, and the particular price earning ratio which is more than the median, we can consider them as the growth, and price earning ratio of those banks which is less than median or less than mean, we can consider them the value. This is the easiest way of defining that which are those value stocks, which banks are basically the value companies and which banks are the which banks are the growth banks, which banks stocks are the growth banks growth stocks, and which bank stocks are the value stocks. This is the easiest way to make this analysis, but it is not the only thing. We have to also use some other parameters which are used to decide that whether it is a growth stocks or a value stocks. So, that is that basically the other approaches, but with this particular information you can use this approach to identify which one is a value stock and which one is a growth stock. Then other thing is that already I told you these inputs we know, you have the cash flow, you have required rate of return, you have the growth rate. So, these are the factors which are affecting the price earning ratio. Let if you see this example, your dividend payout ratio is 50%, required rate of return is 15%, expected growth 10%, your debt equity ratio is 0.5, capital K means required rate of return is 15, your G is equal to 10, then your P by E is equal to 0.5 divided by 0.15 minus 0.1, that is 10. So, now if you see the dividend to earnings, the dividend payout ratio 0.5, you have increased your K to 16%. It was there in 15%, now it has become 16%. If you make it 16%, your growth remains same 10%, your price earning ratio has become 8.33. But if you keep your dividend payout ratio constant and K constant, you have increased your growth, then by 1% same, but price earning ratio has increased. That means it is more sensitive towards the growth than the towards the required rate of return. So, the price earning ratio has become 12.5, but now if you change both, let you have reduced your required rate of return to 14% and you have increased your growth to 1%, you will find that price earning ratio has become 16.66. That means, they are very highly sensitive towards the any inputs. The small change in either K or J, K or G will have a large impact on the multiplier. So, whether the K is increasing or G is increasing or K is increasing, G is decreasing, whatever the different combinations, if you observe in different combinations, the change of 1 unit or 1% of any of the inputs will have a larger impact on the calculation of the price earning ratio in this particular sense. These are highly sensitive. Then another measure we have, that is the price to cash flow ratio. Why basically we are using this price to cash flow ratio? The companies can manipulate the earnings, but the cash flow is less prone to the manipulation. That is why people say that price to cash flow is a better measure. So, in this case, the cash flow is important fundamental valuation in credit analysis. Because of that, it is the same thing and the logic is also same. If the price to cash flow ratio is higher, then we can say that this is a value company, and the price to cash flow ratio is lower, this is also called a growth company. Because the cash flow again is a book measures and the price is a market measure, and this basically is going to help you that if there is a change in the cash flow, then how the price of this particular stock is going to be changed. So, in this sense you can give you the idea in comparison to the other bank stocks, how this particular stock is valuated in the market, how the market basically perceives that one. If the market is perceiving this particular stock in a better way, then this particular judgment can be made on the basis of the price to cash flow. And another measure, if you see that sometimes most of the cases we use, that is called the price to book ratio. It is the market value of equity market value of stock or equity divided by the book value of stock. Generally, this is used as a proxy for growth opportunity. Or also this can be a proxy for the Tobin's Q ratio. So, market value of equity divided by the book value of equity, which is measuring the growth opportunity, whether still there is a chance to grow in the market or not. The same logic, if it is this particular numerator is very low, then obviously the ratio will decline. What does it mean? In comparison to the book value of the share, book value of the stock, the market value is low, and the book value is calculated on the basis of the cash flow which is available to that particular share, particular company. That means, there is still potential, but it has not grown. So, if the market value to the book value is low, what we can say? The growth potential of the company is there, but it is not yet grown. But if the market value to the book value ratio is high, that means already growth has taken place. The growth may further increase, but the probability is also there, it may decline, because the market has perceived that the growth has taken place. If market has already perceived, then further increase is relatively difficult. But whenever it is low, then obviously we can say that the market still the potential is there, but market has not yet perceived that one. So, because of that, there is a chance it will further grow up. So, that is why market to book ratio is also a proxy for growth opportunity, and also people use it as a proxy for Tobin's Q ratio, because relatively Tobin's Q ratio calculation is difficult. The market value of asset divided by the replacement cost. So, the replacement cost is basically difficult in that sense, because of that we are using it as a proxy for that. So, here what is happening, that if the market value ratio is low, we consider they are the value stocks. If the market value to the book value is high, we consider them as the growth stocks. So, like the same logic or same kind of theoretical understanding whatever we have drawn in terms of the price earning ratio, the same understanding or same kind of logic can be drawn for the market to book ratio. So, this is also another ratio people use for comparative purpose whenever they go for the relative valuation methods to decide whether they want to invest in the market or not. So, that is also another way we can define it. Then we have another ratio that is called already I discussed about this. So, the growth opportunity of the company and all these things. Then we have price to sales ratio. Here what is happening? Here we have to match the stock price with the recent annual sales or the future sales, and this ratio varies by the industry, and the relative comparisons are made using price to sales ratio between the different firms with the similar industries. Why? Why we the similar industries? Already in the beginning I said this should be comparable for all those ratios, whether it is price to earnings or price to book or price to cash flow or price to sales, whatever it may be, those particular ratios has to be used with the similar entities. And if the similar entities will be not there, then it will basically giving you a misleading results, or your investment strategy may not work if this particular similar kind of entities will not be considered for your analysis. So, then we have this price to sales. The price to sales ratio, the sales basically varies across the industries. Within the same industry it also varies, but that basically shows that the one company is competent enough to sell more, another company is not. That is a different issue. But we cannot compare the sales of a steel industry with the sales of a services industry like IT industry. So, because of that the similar industry has to be considered, and the business cycle at the trend component of the different industries are different. The cyclical impact, for example, you talk about pharmaceutical company, they are not basically driven by any kind of cyclical fluctuations, but the other luxury products, if you talk about the other type of products which are where the customer is not bound to spend money for that particular product, here the sales will be getting largely affected on the basis of the market conditions. So, because of that the similar entities are required, and the logic is also again same. If the price to sales ratio is higher, we consider them, these are the growth stocks of the company stocks are the growth stocks, or the bank stocks are growth stocks. So, if the price to sales ratio is low, we consider them this stock is a value stock. So, this is the way these 4 ratios are used for valuation, and these are basically used for comparative reasons whenever any investor wants to use those ratios for investments in the market. So, through that the valuation will be possible, which is not exactly measuring the intrinsic value of the stocks, but it gives you the idea that how the value of this particular company is going to be, or whether really this company is going to do well in the future or not in comparison to the other kind of entities, comparative entities which are existing in the market. Coming to the conclusion, that the relative valuation method basically used for comparing for similar stocks based on the different relative ratios, and the relative ratios are basically price to book ratio, price to sales ratio, price to earning ratio, and price to cash flow, etc. And mostly these ratios are used for the identification of the stocks for their portfolio management as a value stocks or a growth stocks. So, anybody wants to identify which one is value, which one is growth, then these are the ratios which can be simultaneously used to decide or to conclude that which bank stocks are the value stocks and which bank stocks are the growth stocks. So, this is all about the different concepts related to relative valuation, and in the previous class we have discussed about the discount flow valuation models. Then further we are going to discuss about the other securities, fixed income securities, which are used by the commercial banks in the market for investment purpose, and we will see the different concepts which are associated with that. What are those different concepts used for valuation of those securities, and how the different kind of risk involved in that particular investments, and how the measurement and the valuation of those kind of securities are done. That we will be discussing in the forthcoming sessions. So, these are the references you can go through for this discussion today. Thank you.